What is NPA? Hey there, money smart people. Ever wondered what happens when someone takes a loan and doesn't pay it back? Well, banks have a name for that. Non-performing assets, or NPAs. Sounds fancy, right? But trust me, it's just a complicated way of saying bad loans. So let's break it down in a simple and fun way, because understanding NPAs is crucial for investors, businesses, and even regular folks like you and me. What is an NPA? All right, let's start with the basics. What exactly is an NPA? When a bank gives out a loan, it expects the borrower to repay it on time, along with interest. But if the borrower stops making payments for 90 days or more, the loan is classified as a non-performing asset, NPA. Simply put, if a loan stops making money for the bank, it becomes a bad loan. And trust me, banks hate NPAs because too many bad loans can cause serious financial trouble. Types of NPAs now. Not all NPAs are the same. There are three major types: substandard assets, loans that are NPA for less than 12 months doubtful assets, loans that remain NPA for more than 12 months lost assets, loans that the bank knows will never be recovered. Think of it like forgetting to pay your phone bill. At first, the company warns you, substandard. If you still don't pay, they might disconnect your service, doubtful. And if you never pay, well, bye-bye phone number. That's exactly how banks deal with NPAs. Why are NPAs a big deal? Now, you might be wondering, why should I care about NPAs? Well, NPAs don't just affect banks. They affect the entire economy. Here's how. Less money for new loans. If banks have too many NPAs, they can't give out new loans. Higher interest rates. To cover their losses, banks may increase loan rates. Financial instability. In extreme cases, banks can collapse due to bad loans. Remember the 2008 financial crisis? A big reason behind it was bad loans turning into massive NPAs. So yeah, NPAs are a serious issue. What causes NPAs? All right, but why do loans turn into NPAs? Here's some major reasons. Bad economic conditions. Recessions can cause businesses to fail and default on loans. Poor lending practices. Sometimes, banks approve loans too easily without checking risk. Fraud and scams. Some borrowers never intended to repay. Hello, bank fraudsters. Sudden personal crises, job loss, medical emergencies, or business failures can stop payments. So, the next time you hear about a major NPA crisis, just know it's usually a mix of bad luck, bad policies, and bad borrowers. How do banks handle NPAs? Okay, so what do banks do about NPAs? Do they just sit there and cry? Nope. Here's how they fight back. Restructuring the loan. Banks try to renegotiate with borrowers to help them repay. Selling NPAs to ARCs. They sell bad loans to asset reconstruction companies, ARCs. Legal action. If nothing works, banks take legal action to recover money. But the best way to deal with NPAs? Avoid them in the first place. This is why banks have strict loan approval processes. Final thoughts. So, now you know what NPAs are and why they matter. They happen when loans aren't repaid for 90+ days. Too many NPAs hurt banks, businesses, and even you. Banks try to recover NPAs, but it's not always easy. What do you think? Should banks be stricter with loans or more flexible with borrowers? Let me know in the comments below. And hey, don't forget to like, subscribe, and hit that bell for more personal finance insights. Until next time, stay smart with your money.